Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Prime Revision Network. So today we have our EIA show. We're going to break it up into our normal 3 segments. And in the first segment, we're going to talk about what is happening in the U.S. when we're looking at crude draws, gasoline draws, but we're seeing more and more builds abroad. And we want to try to talk a bit about how that is and then go deeper into it in segment 3. We also wanted to touch on some of the geopolitical uncertainty, especially in Iraq, and what has happened there, and how that is starting to impact things or not impact things at this point in time. Then we're going to move into the second segment that's going to talk about refined products in the U.S. and really now that we're coming to the end of summer, end of driving season, how are things shaping up as we go forward? And then in the last segment, we're going to talk about global crude and product flows that continue to shift. And we're continuing to see these pivots in terms of where the products are going, because typical areas that were importers are now still importing, but from further away. And then typical exporters are now continuing to shift and try to play that arb in terms of what is coming from Russia. Where is gasoline versus diesel? Because there's still that massive disconnect between, a record amount of gasoline in storage and a record low amount of distillate and diesel in storage. And what does that mean as we head into the winter months? So first, we wanted to just kick off on what is happening in Germany, France, when you look at power prices, and you can see that they have come down. Now, there's always a lot of fear, and fear begets more fear, which then creates a run, and that continues to be this huge adjustment as we go forward. And when you look at some of these movements, again, it went up too much. Now it's coming down. It's not that it's going to continue to retrace. It's just that it went to a level that was, let's call it a blow off top. But we know it was more than that. But you had this massive run up. But now as we head into shoulder season, you're always going to get that slowdown. And I know that when you look at some of the commentary in the world, they're like, well, storage is normal, everything is fine. It's like, look, storage is one piece of a very broad equation. Because yes, you have storage that has gotten better, but can you refill it if you have a polar vortex or if you have a large draw period because of it? How much did you cut industrial production to get to that storage? Are you going to permanently have assets running 15-20% below normal? How is that? What is that going to do to your economy, to the supply there? So there's a certain amount of pieces that have to be balanced between where is storage today and where will it be, and what type of supply-demand dynamics have been created in the interim to create that storage. Because if we were to say, storage is back to normal, everybody can go back to work the same way, that is going to draw down very quickly. And that's why you have to see this kind of balance in terms of where things are going. But now, one of the things that we want to talk about is Iraq. It's obviously in Baghdad with what has been happening. We talked about it in the Econ show a few weeks ago when we look at the Cedrists. So when you look at the different components, the Sadrir, he's a Shia, but he is viewed as a non-Iranian backed entity. So even though there are Shias that are within Iraq, you have to understand that the dynamics between the Sunni and Shias, obviously there is that difference in terms of who they view came next after Muhammad. But the Shias within Iraq do not identify with Iran. They feel as though they were left behind during the Iran-Iraq war. Both of the Iraqi Shias were bombed by both sides. There was a lot of misgivings between there, and there was a significant amount of distrust within Iraqi Shias versus the Iran backdrop. So there is a huge push to try to get them out of the country, reduce the Iranian influence, which, as we all know, has been very large within the country. And this is the push back and forth. And we'll go more into this in the Econ show on the geopolitical side. But when you look at, all of these things are happening, but it's in Baghdad. It's obviously there's protests. There's been a lot of different push back and forth. But Iraq is a big country, and a lot of that crude continues to move unabated. And it's important to appreciate that both sides need that oil. Whether or not either side wins, they know that once they win, they still need that crude on the other side to finance their government, their subsidies, and what have you. So nobody's going to look to stop that or damage it. So you could get some protests that will shut things down. You could get some of that stress. But when you look at the actual flows, it's continuing. So Iraq is exporting about 3.35 million of crude from the south and between 75 to 90,000 barrels a day from north of the country. Al-Yassiri, Director General of State-Run Oil Marketing Company, SOMO, says, was quoting it, Iraq has the capacity to boost oil exports. Iraq will boost exports to Europe if asked, considering raising Europe's share of Iraqi oil exports to 40% from 20% currently. Seeking new customers in Europe, delegation from SOMO plans to travel to Germany for oil export talks. Iraq recently received requests for more oil supplies to Asia, mostly China. Now, mostly India. So when you look at some of the different shifts, the demand side is going to be some of the other types of backdrops in terms of where do things flow, how do they adjust, and when you look at what is flowing into Asia, it continues to be depressed. We continue to see more of this get stuck. But and we'll go through this in the segment 3, the Middle East storage has come down, but we've seen things trading below OSPs. Now, Saudi doesn't go below OSPs. They'll give you incentives that will discount it, but Murbain is now trading below. It's trading below benchmark, and that's what they're trying to do to clear some of the glut that has clearly been there and remains there. Now, on the diesel side, arrivals continue to surge in August as they continue on the Europe's diesel imports. It's now well above 400,000 barrels a day. We see a bit more coming behind it. Then it'll drop off, but that's just more because of timing. There still is a huge need for diesel in Europe, which is going to, again, continue to move this product from the Middle East, from Asia into the European and just the Atlantic basin in general. U.S. gasoline imports from Europe declined to a 3-week low. But again, it's just a matter of just timing. Right now, the U.S. is pulling in about 214,000 barrels a day, versus the 229,000 barrels a day. But when you look at the amount of gasoline sitting in it, which is at a record level, sitting there, you continue to see a huge, essentially a huge number of shifts. And this is what we've been talking about. So typically, Europe ships gasoline to the U.S., then the U.S. ships diesel into Europe, and there's typically this back and forth. The gasoline comes into pad 1, the diesel goes from pad 3, and you get this back and forth. But now you have gasoline at a record high above 2020 numbers, but we're not seeing any real increase. And there's a lot that can be said about that, which is what we're going to talk about more in segment 3 when we look at how these shifts continue to adjust. Now, total crude products, when we look at underlying flows, deficit narrowed from 45.9 to 36.3. This is total crude and products. Then when we break it into its different pieces, total crude stocks, land and floating, surplus narrow from 19.7 to 16.7. But when you look at it, there's still a large amount of land and floating. And again, we're going to talk and break them apart, but there is a lot of crude that is sitting there on the water, moving about, even though their demand continues to be fairly lackluster when you factor in China. And we're going into a seasonally slow period. Total oil product stockpiles, deficit narrow from 65.6 to 53. And you can see it here. It continues to as we were saying, the rate of change is going to be consistent. But the comps get easier. With you look at 2021, it started to decline sooner. Well, here we're continuing to climb, but on the product side, it's not uniform. Gasoline is the one driving this, as distillate and diesel continue to be grossly underwhelming, and that's where we continue to see this glut. in one, shortage in another. But again, they're both created at a refiner. So you need the diesel crack to carry the gasoline crack. And if that stops, that's when we can have some of these problems in terms of where are they going to put that excess gasoline. Now, the JMMC is scheduled to take place on September 5th, with the OPEC Plus meeting supposed to be right after. So it's just going to be, this is something to think about as we go into next week in terms of what should we see. It's likely, Saudi Arabia talked about cuts. It'll be tough to see if we get cuts or not. I think it might be a bit steady state at this point. They roll out some sort of cuts, but whether or not they cut or they don't cut, OPEC production is below what's allowed. And it's going to stay like that because, again, it comes down to floating storage, and there's no incentive for West Africa to increase given where floating storage is. And when you look at the Middle East and even though floating storage has come down, there's no impetus to increase given the fact that there's going to be more available for export. Iraq is saying that they're willing to put more out there and actually shift the direction of some of it. And where is the Russian crude going? Because it continues to take more market share in Asia, as it doesn't go into Europe, which is what Iraq is talking about, of going from 20% allocation to Europe to 40%, because they're sensitive to, well, what is the demand in China? Does it make sense to go that way or to shift gears? And that's when you start looking at land storage. So here you can see the deficit widened from 51.7 to 53.5. And the comps, as we've been saying, the comps get easier. You could see that cloud coming back down. We'll see it come back up. West of Suez, deficit widened from 31.4 to 32.5, but it's still in the bottom of the cloud, tracking pretty close to where we are versus 2021. We just see it, again, very steady state, not much adjustment, with east of Suez deficit widening from 23.1 to 24.2. But now there's a more crude that is signaling going into Asia, which will start to adjust that a bit higher. Now, when we look at floating storage, the surplus narrowed from 52.7 to 44.6, but you can see it's at 2021 levels. It continues to be well above the average of 2016 to 2019. But it's important to understand that even though it's pivoting, and we'll talk more about this in segment 3, even though the floating storage has come down, it's because it's gone into motion. So now we want to look at what is in transit, what is in floating storage, and those are some of the key shifts where it's going from floating storage into transit. So it will show up in what we're seeing in both Europe and Asia. You will see those cargoes show up. We'll then increase this number before it goes and increases, obviously, the onshore side. Now, west of Suez flipped to surplus from a -1 to a positive 1.3. And we're going to continue to see this flip back and forth, especially as West Africa remains lumpy. And then east of Suez, the surplus narrowed from 52.7 to 41. And a lot of that is driven from the Middle East crude getting sold. It's, again, the discounted side. Discounts can vary in terms of how they are, but we are seeing some of those discounts, which is pushing this into the market. August loadings of clean fuels from Asia to the Americas rose by around 35,000 tons from a week earlier to 440,000 tons. And again, we're still seeing a lot of these clean fuels, and most of this, if not all of it, is distillate, is diesel, because again, that's where we have those shortfalls. So now crude stocks, crude drew by 3.33 million. When you look at it and factor in the SPR, it drew by 6.39. Again, that's something we're seeing some of that slowdown on the SPR side. It'll be interesting to see how this, is it something where the government just stops it? Do nominations naturally stop on their own as we come into shoulder period? And that's going to be an interesting one to pay attention to. So when we look at where were the draws, they were pretty much across the board except for Pad 5, which had a small build. Pad 2 had a draw of 1.61 million. Pad 3 had a draw of 1.7. When you look at Pad 2, so Pad 2 had a big drop in imports, which we thought was going to happen. It went even below what we were expecting. Some of that could have been just, again, an overshoot to the downside because BP Whiting had an issue which caused essentially most of the facility to shut down. They should be back and on fully operating by Saturday. But again, that also impacts it. But when you look at the crude side, when BP Whiting is obviously massive, so when something that big goes down, and this is going to be specific just to PADD 2, a lot of times you'll see a big increase in crude storage because they're not drawing what they normally do, and a big drawdown in the products just because they're going to feed the market from what is in storage until things can right themselves. So that's just, we could get something that's a bit wonky in PADD 2, but that's just, just to keep that in the back of your mind as we go through this week and into next. Cushing had a draw of 520,000 barrels, still 16.3 million below the average, and we'll talk about that in a minute, with PADD 3 having the draw of 1.7, but still only 5.2 million below the 5-year, and actually above last year's numbers, as PADD 3 continues to be fairly normal. And then when we look at the production numbers, up by 100,000 barrels, this is what we were talking about. There was a lot of hiccups when you look at Gulf of Mexico, when you look at some of the movements that we were seeing in terms of frac spreads and just where are things turning on, turning off. So it's just more noise. It's not that we're seeing a big a drop in actual flows. And then the crude physical market, U.S. and Brazil flows continue into different markets, and we're going to talk more about in segment 3 how the U.S. crude continues to flow very aggressively into Europe. So, and that's why it's important to keep an eye on where PADD 3 is. And right now we're tracking right where we were in 2017 and 2021. And if you take out that yellow, which is obviously 2020, we're right at the 5-year average. So it's not like there's any big shift. And this is just a mixture of refiners not operating at the same level because refinery run rates in this region continues to be below normal. And even that's offsetting the fact that imports are also well below normal, maintaining these flows, which is right around where they were, as we said, in 2017, 2021, and 2016, when you look at just where they normally were in PADD 3. Crude storage and Cushing, as we were saying, fairly flat. We don't see too much of a move higher, up or down. We think the trend will be up, but it'll be measured, and that we're not seeing this huge surge, just a very measured increase. And again, we've had a strong run off the lows from June. Now we're seeing some of that pullback, and it's just going to be some of that management. But typically you have crude building this time, really, let's call it, in the next week or two. And then from that point forward, so say the middle of September to the end of October is where we normally get some builds. And you can see that with just other years where we normally get that trend higher, and we don't think that'll be any different. Now, when you look at runs, obviously PADD 2 had the big drop of 148,000 barrels a day. A lot of that being obviously BP Whiting. So utilization rates dropped by 1.1% from 93.8 to 92.7. And that was all driven by PADD 2. That will reverse. We think we're going to stay around this 93% area. And then that'll start to drop off as we get into the middle of September. But because of where distillate is, there's still some of that impetus to keep some of these refinery run rates a bit higher versus where they normally are as we go into the fall months. But when I say that, it's just a matter of it's just going to go sideways, and you can see that there's that normally steep drop off as you get into the middle of September into the end of October. And the question is just going to be the rate of change. Is it going to be an aggressive one, not as aggressive? And we just think that given where the distillate crack is, and if they can get that type of crude that has a high disty cut, it would be in their best interest to maintain a bit more elevated cracks, and especially because they've been able to manage their gasoline storage a bit better than most. And it's really because of what is being pushed down into Latin America has kept the PADD 3 guys fairly balanced on the gasoline front, enabling them to run pretty hard on the distillate side while still having a place to put their their gasoline. Imports dropped 217,000 barrels a day, but you can see it was all driven by PADD 2 with a drop of 712,000. PADD 1 had a small drop, but of 114,000 barrels a day. Pad 3, an increase of 293,000 barrels a day. That was what we were seeing. We think there's enough right there to maintain above 1 million barrels a day, going from 971,000 to 1.2, 1.3 million. We should stay between that numbers because there is enough demand coming through. Pad 5 had an increase of 149,000 barrels a day, still above the 5-year. And again, Pad 5 remains lumpy, but that's, again, we expect to see that stay elevated in that region. This is looking at imports into Pad 3. As we were saying, back within the bottom of that cloud. We do think it trends higher, just given where the market is right now and the availability of some of the Middle Eastern crude that could be at a discount. And that would, again, increase what's coming specifically into the Gulf of Mexico. But not like we're, again, blasting through the top. It's just coming in where Pad 2 had that big drop below the 5-year to the lower end of the cloud. Again, we just see this staying above the 5-year average and realistically within that top end of the cloud, towards the top end of, and the cloud, again, is that seasonal period. We just think that we're going to average towards the higher end, given where runs are, given where storage is in Pad 2, which will keep things rolling through. Implied demand, holistically speaking, you can see gasoline had an increase of 157,000 barrels a day, going from 8.43 to 8.59. Again, it's still low. We still see this going back up. Obviously, it's just going to be that balance between a lot of kids went back to school again last week and then the beginning of this week. My kids, and I know a lot of people around us, they go back the Tuesday after Labor Day. So you're coming towards the end of that level, but 8.59 is still too low. The view for us is going to go from, let's call it 9 to 9.1 to about 8.7, 8.9. So we do think there is movement higher, obviously on the lower end, but there's where a lot of that pressure is coming in. As trucking falls down again and kind of flat lines at this level, you're going to have this waffling back and forth between that 3.5, 3.75. So the drop of 322,000 barrels a day isn't surprising. It's just how long are we going to stay here before people turn their heat on, before we start to see things happening? And again, seeing some of that seasonal bump in disti. Jet is preparing for the Labor Day push. So again, we have that one more push as we come into this weekend, which is obviously Labor Day. People will have their end of year barbecues. You'll see more activity. And that's usually what we see, and we have a chart on that in segment 2 to really show where that demand pop will be. But again, we also will get a demand pop in gasoline. It's just going to be a matter of it's not going to the July 4th highs. But that's why we will see that one more surge and then that drop off, which will then kind of keep us below that 9 million. But we will get that 1 or 2 more weeks that's going to be above that 9 million mark. Then when we look at gasoline implied demand, again, you can see that there's normally this big spike. And the spike it depends on timing, on when does Labor Day fall based on, again, the calendar, because each of these is going to be seasonal. So this in some areas, like this reporting period would have been Labor Day versus others, and that's where you can get some of the movements. But you can see that there is normally a spike, there is normally an increase. It normally challenges the highs that we saw over the previous summer, through the previous summer. So that's where we do expect to see that increase. It's just going to fade very quickly, as it has previously and in other periods, just given, again, the low demand levels. Now, when we look at crude oil, excluding the SPR, you can see just sitting fairly stable. Again, we just expect it to go sideways and then actually start to see a bit of an increase as we get to the end of September. And it's not because we're going to get this huge demand drop. It's seasonal. It's just you'll get a demand drop in the sense of you have refiners going into maintenance season. As refiners go into maintenance season, you build some of your crude preparing for the winter push. Nothing crazy there. So again, something very similar to what we've seen in normal years. And that's when the pivot typically starts at the end of September and continues through November. Days of supply for crude, again, fairly flat, not too much where we, just given where refiners are, even though crude is at a lower rate, again, refiners are also at that lower rate as well. something very stable. Total commercial stockpiles, again, with the drop in diesel and gasoline, that's keeping us here because crude is fairly normal when again, all things considered. It's so that a lot of this drop is on the product side, and most of it is being driven by distillate, which is keeping us well below what is normal when you look at total U.S. commercial oil storage and products. Oil is again, it's also regional. So when you look at crude is fine in PADD 3, a little bit lower in some of the other areas, but PADD 3, 4, and 5, fairly flat to normal versus historics. Distillate, on the other hand, record lows in PADD 1, a little bit lower in PADD 3, and that's some of those big drivers where gasoline is on the lower end, but something that can turn quickly based on the amount of gasoline that just sits in the market that could easily be imported if it makes economic sense to come into our market. And here's where we're looking, where you can see we're flatlining, which is what we think continues here. And you could see that other years you normally have a drawdown coming into this period. We just expect it to be fairly flat given the pressure on demand. Exports remaining elevated, imports low, but with lower demand, lower imports, and just where refiners are trying to target, which is that distillate cut, you're going to inherently get more gasoline, which again is going to help offset even an increase in demand, which is going to keep us fairly flat. Now, when we look at distillate, again, the third, now we're still the second lowest ever over the last 29 years. We're still at a very low point, and this is that bigger concern that we have as we head into the winter months. Jet fuel, big drop down in storage, and this is because you are having, we normally get one last bump in flying before the September lull, obviously Labor Day. So you have some of that big pull coming out of storage and getting moved to the airports to prepare for it. And then when we look at just the crude curve, it continues to come under pressure. It's actually getting more and more bearish on the longer end of the curve. You can see it's now below 60 as you get into the out months. And a lot of this is based on where Iran is. Are they coming back? Are they not coming back? We keep seeing headlines that are saying one thing versus the other. We do think there is an agreement. It's done between Europe and Iran that sends it over there. We're going to talk more about it in segment 3. But again, that's putting pressure on the curve. We still think that there's opportunity in the belly of it. I get the front month. Right now you have WTI trading at 90. Does it trade at 91? Does it trade at 89 next? Your guess is as good as mine. The physical market is weakened a touch. We have more cuts coming through in terms of just differentials. And the question is that the biggest driver that we're going to see going forward in terms of the physical market? And we'll talk more about that in the segment 3 as well. As floating storage drops a bit, but still remains a little bit elevated, which again supports more imports coming into PADD 3, coming into the region. And it's just going to marry with, and it should actually start to increase just given the amount of crude that's sitting in floating storage in the Middle East that should get released as they try to manage that, which again will provide some opportunity for PADD 3 to get some discounted cargoes, or at least somewhat discounted cargoes that have a higher disty cut and keep products moving, or at least distillate production moving forward. Now, that's what we have for you in segment 1 and segment 2. We're going to go deeper into refined products and what is happening in that market.